Welcome everybody. My name is Chris Capri, founder of Second Skies. We are doing a premium presentation here for you. Today's session is with FX Street, and we'll be talking about trading with the Bollinger Bands and the ATR. Now, before we begin this one, for those of you who have been to my sessions, you'll know I highly welcome and encourage questions. So please, if you don't understand anything or have any questions about anything regarding the material, please ask at any time. I encourage questions. This is an open forum. I like it to be engaging and at the same time highly interactive. So this is for you. Please ask questions at any time and don't hesitate with that. I love fielding questions. Okay, so today's session is really going to be mostly about trading with the Bollinger Bands, but then also using it in combination with the ATR to see how they can be very powerful indicators. One of the things that are challenges is in trading the currency market, we don't have access to order flow or overall volume levels. Unlike the stock market or future market where we can tell where volumes are, we get that information readily because they're going through central exchanges. We don't have that in currency markets. So to get volume and volatility levels, we have to look to the indicators to really give us a sense of that. And for the currency markets and the way they work, when volumes, what often precedes the very low periods of volume, often come massive breakouts. And we can use the Bollinger Bands and the ATR to determine that, whether we have a really clear breakout or a large one that's about to happen. The other thing that these two indicators can be used for very well is in spotting reversals or fades after trending moves or general swings, which a lot of the pairs do consistently. They consistently swing between floors and ceilings, floors and ceilings. And a lot of pairs have short-term moves of 200, 300, 400 pips, and then they start to reverse. And we can use this in a way to really detect really good entry points, high probability entry points to catch those reversals instead of waiting for another fade opportunity. And so let's get into this here. Okay, Bollinger Bands. So this is honestly, it's one of my favorite indicators. And the reason why I constantly have it up for most charts that I look at is because it gives you a good indication of volume and volatility. I think most of us probably understand how to use Bollinger Bands, but just to go over real briefly, statistically, it was a great measure that was created by John Bollinger Band in the 1980s. And what he did is he used statistics and standard deviations or the standard bell curve to measure a pair's volume and volatility. Now, two standard deviations contains about 95.4% of all price action. Therefore, if any pair is trading outside of that, to push the 96, 97, 98, 99 percentile envelope, there has to be an increase in volume and volatility to do that, where there has to be a very heavy skew with the order books. And so when we have those heavy skews with the order books, if we're going in the opposite direction, we want to look at that as either a cue to get out of the way, or if we want to go in that direction, we want to use those cues to help take advantage of those large moves that are often being created by large players. And so that being the case, Bollinger Bands are fantastic for giving us volume and volatility because if the pair is caught within the Bollinger Bands on a particular time frame, then that means that the order flow books are not skewed heavily towards one or the other. And so therefore the pair should oscillate between a floor and a ceiling. So excellent indicator for that. One of the few indicators that really gives us a good measure of volume and volatility. They're stellar for range markets. That's what they were originally designed for. But on a more advanced level, they're excellent for also for trends. Most traditional articles that you see in them is all about range or swings or reversals for the pair. But they can actually be used in trends in a very, very advanced way. And so they're actually just an exceptional indicator all around. Great for signaling reversals or fade. And they are probably by and large the best indicator for determining when massive breakouts are going to happen. There really isn't a better indicator out there that can really show you in such a clear visual way when we are going to have a huge, huge breakout in a pair. And so that's what we use them for. All right, moving on to the next part. We're going to go over a strategy today called the double Bollinger Band bottom or top. And I'm going to talk about the time frames. Now, it happens obviously a lot more on the intraday time frames. So when you see it on a 1 hour chart, it's usually a pretty strong single. I tend or tend to not go below the 1 hour chart for the Bollinger Bands, just because the Bollinger Bands can get violated a lot at the lower and lower levels. But when you see these signals on a 1 hour chart, they're usually very, very strong signals. When you see them on a 2 hour chart, they're even greater. And then when you have them on a daily chart, they're excellent, although they don't happen as much. They're few and far between. And so we're going to actually go over some examples here. Now I'm going to go over the rules for using this strategy, and then we're going to look at some charts. We're going to look at a bunch of case studies and what pairs you can apply this to. So the first is, for a trending move or a clear directional move, whether it's short-term, medium-term, or long-term, what you're first looking for is a move that really pierces the upper Bollinger Band if it's moving up, or the lower Bollinger Band if it's moving down. And so you're really looking for something that not only pierces it to trade outside of it, but hopefully has 2 or 3 or 4 candles or several candles outside of the Bollinger Bands. That suggests that the order books got heavily skewed to one side, and when they got heavily skewed to one side, it was a clear directional move. They just forced the pair to move into its 96, 97, 98 percentile. Now, what often occurs after those moves is either a decent-sized reversal or at least a really, really good fade on that. Because a lot of those short-term players will be out. They'll have taken profit. They will have run into other buyers or sellers. But usually a pair cannot sustain too long a period of time in the 96, 97, 98, 99 percentile. It's just not something that most pairs have the capacity to do. And so we're going to talk about how we can actually use that as an excellent trading strategy. The second part of this trade that we're looking for is that we're looking for the pair to rebound back into the Bollinger Band. So if it stayed outside it for several candles, we're looking for a move back into the Bollinger Bands. And then what we're looking for is, if it's a downtrend, we're looking for it to make a second low, or if it's an uptrend, we're looking for it to make a second high, kind of like a double bottom or double top, but not quite that, but close to it. So we're looking for, say, it to attack a certain price level or a certain resistance level, to get rejected there initially, and then to re-attack that level. Now here is the key distinction, is that what we're looking for is when it makes that second low on the bottom or a second high to the upside, that second attack at that support or resistance level, we're looking for it to not get as high or low as the previous attempt did. And we're going to go over a chart and show you how this works, but imagine a pair really pushes hard outside the Bollinger Bands, hits a certain ceiling, and then it tries to go back to it, and it doesn't quite get as high. Just price action alone suggests that the pair is likely going to fade or reverse from here. But we're going to add a little more criteria into it. The third part of this criteria is that we're looking for the Bollinger Bands starting to contract. When they contract, that signals the reversal or fade is a high probability at this point. You're talking 75% and above. And then the last part of this logic here is that the second touchdown of that lower high must be 12 hours apart. We don't want it to hit that lower high and then to just stay there. That's a consolidation move. And consolidation moves like that typically suggest continuation. So we're looking for an attack on a certain level. Let's say it's 149, and then to re-attack that level several hours later, but then to get rejected there a little bit below 149. And so this is what we're looking for. These are the general rules for the trade. In terms of the entry, stop, and limit, and I'm going to show you how all this works with our charts here. The entry is the first candle after the confirmed bottom or top. So as soon as we have that really good move towards the bottom or top again, we want to look for that candle that gets within 15 to 20 pips of the Bollinger Bands. So if it was piercing the upper Bollinger Band, we want it to retract from it, then re-attack it, and get within 15 to 20 pips of it, but not get as high, and start to show a candle of reversal at that point. I usually like to enter 2 lots on these trades, and the targets, the first lot is going to be the middle of the Bollinger Bands. The second lot is going to be a move to the other side of the Bollinger Bands. Now the other option on this one, we're going to show how this optional second limit works really well, is that the limit becomes the Bollinger Band as a trail. So if we pierced a huge low, and then we came back in the Bollinger Bands, created a new low, but didn't get as low, then the pair should fade or reverse to the other side. Oftentimes those fade or reversals can continue for several hundred pips. And so we can use the lower Bollinger Band in this case to trail it until it makes contact with it. That can often keep us in the trade much longer. Stops are pretty tight on this one. Stops are about 15 to 40 pips outside the Bollinger Bands, depending upon whether you're on an hourly chart or daily chart. And once you hit the first profit target, the second stop is brought to free at that point. Okay, so now let me close this one and let me give you a chart here, and we're going to go over an example of how this works. Okay, so this was in play. Let me know when you see the charts here, and then we'll move on to that one there. If anybody could type in and let me know, that would be fantastic. Okay, great. Thank you. All right, this happened most recently on the pound to US dollar. So pound to US dollar as a whole from a medium-term structure has been looking very bearish. It, since it fell out of that year-and-a-half trend channel, it dropped, almost 2,000 pips. I mean, it was about 1,800 pips. And each retracement that it's done since then has been getting lower and lower. It had one move all the way up to the 99.50 level. This most recent move went up to 97. And there was an interesting signal. We got a signal on the double Bollinger Band. This is the double Bollinger Band sell, or double Bollinger Band top sell indicator. And so what happens is this. We have the bounce off the 94 and 93.90 levels. And it's a pretty smooth, orderly move the whole way. It's not necessarily impulsive, and it's more towards the corrective, but it's still a strong move. You're talking about 340 pips roughly. Now, we had constant pressure upside on the Bollinger Band, and so we created this interesting signal going into Thursday afternoon, evening, where the pair pierced it, got to a new high of 97, came back within the Bollinger Bands. The Bollinger Band started to contract, and then when it came towards that new high, it didn't get quite as high. So we now have our first logic activated. It's been pressing the upper part of the Bollinger Band. And then when it came back in, it didn't create, and it created a second attempt against that. It didn't make a new high. And so this to us was a very good indication that it was going to reverse here. There is 12 hours apart here. I've actually counted them out. There is 12 hours apart between the first and second move. And this little next attempt here gets within 15 to 20 pips of the Bollinger Band here. So this alone suggested to us, wow, here comes an excellent fade opportunity on this pair. Bollinger Bands are moving horizontal. We've had the constant pressure of the upside for 5 days now, and then all of a sudden we come back in the Bollinger Bands, and we aren't able to create a new high at a subsequent attempt. That suggests the pair should revert back to the mean, minimally revert back to the mean. And so what happens is that as soon as we see this little candle stab up and then close, this is where we're looking to get in. We're looking to get right in here. We want to get close to the Bollinger Band because the Bollinger Band is the container. The Bollinger Bands are what containing 95.4% of price action, and if they're moving in a barrel style or horizontal, then the pair should oscillate between the floor and the ceiling. And so what we do is that's where we get in. We try and get in within 15 and 20 pips. If the Bollinger Bands are here at 32, a good entry would be right about here. If you can do it about 30 pips if you want to, but the closer you are to the Bollinger Band, the better. And again, you also want to be close to the previous high, but it should make a lower high in this case. Now our stop is just outside the Bollinger Bands, assuming that the Bollinger Bands will contain volatility. We take price action midway on the first lot, which is right about here, and then the second lot we're taking profit as soon as it makes contact with the lower edge of the Bollinger Band. So you can see how these fades can often be very powerful moves. I mean, if we even got in at 97 flat, we made 100 pips in relatively 2-3 hours. So on a 1 hour or 2 hour chart, this fade or double bottom or double top sell signal is excellent for qualifying when a real reversal or fade is going to happen using all the additional qualifications.